Welcome to episode 72 of the Cashflow Connections podcast. Our topic for today is achieving parabolic growth through masterminding. When I first got into the business, there were very few options in terms of high-quality educational content or even coaching content. There were a couple of companies out there, and I'm not going to mention any names, but trust me, well-known companies that had coaching programs that were $25, $50, or even $100,000. And a ton of people got burned through the years doing this because a lot of these coaches were just simply coaches. They didn't really have any transactional, functional real estate experience. The people they were teaching may have had more real estate experience than them. And after enough people had negative experiences online, they were able to share these experiences online through the internet. That part of the industry sort of shifted. The whole coaching real estate industry really shifted because of it was basically a taboo at this point. But in the wake of that shift has come a new era of high-price groups, although this time, a lot of them are exclusively attended by extremely influential and successful real estate entrepreneurs, all of which are there to share and learn from each other. And today, we're joined by the founder of one of those mastermind groups, which is Collective Genius. Now, I'm not personally in this mastermind group, but I know two people that are, and both of them are very influential, very successful in the space, and they're extremely active on an annual basis. And they had a lot of really positive experiences in this mastermind group. So in this conversation today, we're going to talk about how our guest had built up a significant business, but the market essentially forced him to hit the reset button. This is in 2008, as I'm sure a lot of you probably assumed. We're going to talk about why he founded Collective Genius. What was the motivating factor for doing this? How do they add a lot of value to the people that attend? Because obviously the ticket price is not cheap. So how do you make up for that in content and takeaways? We're going to talk about some of the key things that he's learned from talking to so many extremely successful real estate entrepreneurs. And most importantly, what are some of those most common reoccurring challenges that can always come up, and how are people solving those challenges? Because if you talk to anyone that does consulting for businesses, they're usually one of 5 things that a business is doing wrong. So how we can identify those 5 things, we can identify how to solve those problems, we can really help people scale their business and be successful. And of course, we're going to discuss the importance of work-life balance and a few tips to balance the two. And that's obviously something that's going to come up a lot in these mastermind groups, especially when it's with ultra-successful people. Don't forget, we are reopening the CFC mentorship program for another 3 more students in Q1 of 2019. This is an extremely dense program that I created in 2018, which covers everything that a real estate entrepreneur or a capital raiser or a passive investor would want to be an expert in. The goal really was to get as much knowledge into their minds in as little time as possible. Basically, what I wish I had when I started in the business of syndications in 2010. Like I said, there's already been 4 students that have completed the program. They had a really positive experience, which really motivated me to reopen it. And I created a new ebook that is free to everyone that covers some of the content that will be going into a lot of detail in the mentorship program. The ebook is called Leading the Round, 111 Questions Passive Investors Should Be Asking. And you can check it out at cfcmentorshipprogram.com/111-questions. That'll be available in the show notes page. If you're interested in being a student of the program, go ahead and click the Apply Now button on the website. That's cfcmentorshipprogram.com. And we'll set up a call just to discuss your goals and to make sure it's a good fit, because it's obviously something we take very seriously. And one more thing, if you use Instagram, we have an Instagram now. You can find us at Cashflow Connections on Instagram. We post short clips of our episode every week when we put out a new episode, and it gives you a little tease of the episode. And it's pretty cool. It's a cool way of getting a little tidbit, but also you get a quick insight into what I personally thought was the most interesting takeaway from the conversation. So like I said, shoot us a follow at Cashflow Connections on Instagram. All right, hope you enjoyed the episode. How's it going, everyone? Our guest for today is Jason Medley, who is the founder of the Collective Genius, which is a real estate mastermind group that consists of 120 of the nation's top real estate investors who meet quarterly to share investing systems, strategies, and profit sources. Collective Genius members, they buy houses, they sell houses, they lend money, they borrow money, and invest in syndications together, along with sharing their systems and resources with each other. Jason, thanks again for coming on.
Yeah, Hunter, super excited to be here. Looking forward to engaging with your audience today and hopefully providing some value.
Oh, I think we're going to provide a ton of value. I can't imagine the overwhelming amount of volume of high level conversations that you had over the years. And that's really what I want to focus on today is some of those really interesting key takeaways. But before we jump into that, I want to just get an introduction to you. And this is the first time you've been on the show. What's your background like? How did you get involved in the real estate sector as a whole?
Sure. First and foremost, I am a husband and a father. I live here in sunny Tampa, Florida. Originally from Louisville, Kentucky, and transplanted here just after college. So I've been here like 25 years. So I'm native. Drops below 65 degrees, I'm whining and fussing. But anyway, as far as real estate, I have been in real estate since 2000. So I guess we're kicking up on almost 19 years now. I started out, kind of had a health battle at a fairly young age and had to take some time off or some disability, if you will, close to kicking the bucket at the ripe age of 29. And during that time off, I was refinancing my home, and I couldn't take the docs or deliver my docs because I was sick. So this young kid pulls up to the house in a brand new black 911 Carrera Turbo Porsche. And although I'm not a Porsche fan, I thought, how is this young man driving such a vehicle? So I asked him that, and he said, I'm in the mortgage business. And so instead of going back to corporate America, I saddled up and went to work for a mortgage broker. And a year later, I opened my own brokerage. And so was rocking the house, right? We were in another boom time, the early 2000s, thought I was cool, lighting it on fire. And then being in Florida, which is one of the first markets typically to turn during a downturn, I got smashed up in 2008 and 2009, hit the zero button, as I like to call it, lost the house, lost the marriage, lost the business, the whole kit and caboodle. But it was a very, very, very impactful lesson because it helped me. I learned a lot of things. Number one, live below your means. Number two, anybody can thrive and be successful in a hot market, right? I didn't really know how to market, though. So when I got banged up, I learned that I needed to be able to generate a lead versus shooting fish in a barrel, and then, kind of set out on a quest from that point forward. And for the rest of my professional career up until this day, really have become a student of marketing. So what happened is I got banged up 2008, 2009, really tried to figure out what am I going to do? So I took the skill set I developed as a mortgage broker and started negotiating short sales for agents at that time. And because at that time, the real estate market or landscape was dominated with short sales. Couldn't stand the business. I am a people pleaser. I love to make people smile, love to make them happy. And when you are negotiating short sales, they always take too long. They never go the way you think they will. And the banks make irrational decisions. And so the agents I was negotiating for were not happy. And it wasn't really necessarily a direct reflection on me. It's just that when something takes that long, human beings don't operate well inside of those 9 months, a year, 18-month confines for banks to make decisions. And so bottom line is that I met a friend of mine who was actually flipping short sales. And I figured out very quickly that was a far better way for me to go. Started flipping a few short sales. And just as I was getting going, getting momentum, getting back on my feet from hitting the reset button, the zero button, as we call it, looked up and started, hey, I'm on track here. I'm banging out some big deals. You didn't have to have money back then, Hunter, right? You could do what were called dry closings. If you were selling a house for $200,000 at 10 o'clock or buying it for $200,000 at 10 in the morning and reselling it for $250 at 3 in the afternoon, you could use your end buyer's $250 to pay and cover a year closing onto $200. And so the rules changed. Everybody kind of got savvy to that and said, hey, you can still do it, but you got to have your own money on the first closing. That 200 grand's got to come from you. And so that is when I saw an opportunity because I was flipping a big deal in which I was going to make about 30 to 40 grand on. That the rule change, if you will, by the title companies went into place in the middle of that. And I didn't have the money to take down the deal. I was going to use the end buyer's money. And so I had to call a friend real quickly and say, hey, man, I'm going to get a $48,000 check, but I need $402,000 for a couple of hours to do it. And it was at that moment that he lent me the money. I paid him a couple of points on that. Of course, when you borrow $402,000 and you send back your friend about little over 410 a few hours later, he asks, can we do that again?
Right.
And can we do that again? And so it was at that point where we kind of realized if it was happening to me, it was happening to everybody as far as having your need wet funds. And we saw an opportunity in the marketplace and created a transactional funding company. We were fortunate to be on the very front end of that wave. One of the first to the party, if you will. We got very established, ingrained in the business. We had a big head start, and for about 4 or 5 years, we lent out about anywhere between $80 to $100 million, and we were making 2 points a day on transactions. And so that was really what helped me get back on top from lack of a better term, getting a punch in the face, as Mike Tyson would say. Everybody's got a plan until they get punched in the face, right? So that happened in 2008, got back on my feet with transactional funding until around 2010, 11. And that's when I actually started the Collective Genius, right? That'll kind of bring us up to current here. So we can, start moving forward in the podcast. But that's when I started the Collective Genius. I developed an internet presence where I was using webinars and so forth to teach people. We'd bring on our customers who we were lending money to on the short sale flips to teach people how they were doing it, kind of case studies. And then we said, hey, if you can go out and duplicate this, come to us when you're getting ready to close and we'll fund your transactions. So I developed a following on the internet, just much like you have here, Hunter, a list, a herd, if you will. And through the course of that following and through the course of, being able to identify who our biggest customers were, but based on how many times they were lending money or borrowing money from us on a monthly basis, I started the Collective Genius. I invited, our top customers that we were lending money to from across the country. In addition to that, the higher level folks that were on our webinars, which is really, if you will, kind of a different outlet, same thing we're doing here today, a podcast, if you will, just a different medium, to the first Collective Genius back in, I want to think it was 2010-ish. And, it was me and about 9 or 10 other people in a room. I think I went home and cried after it was over because it just didn't, it didn't turn out like I wanted it to. And not everybody came on board, and, I worked my tail off, and, but like any business, like anything in life that you're passionate about and you really want to manifest, it usually starts with that blood, that sweat, and those tears. And so, but here we are, 2018, we have 120 members. We have a very high selection criteria. Typically minimize it. If you don't flip at least 50 single family homes a year or have at least 50 doors, in your rental portfolio, whether that be single family or multifamily or whatever. And we have different disciplines as well. We have mobile home park folks, we have storage facility folks as well. But bottom line is we're only looking for, very high level sophisticated investors who are doing well and already running hard. And so that's what we have today, my friend. That's the Collective Genius. I'd like to think that we are, and it's another industry or area where I was fortunate enough to be first in the space. And actually we spawned several other masterminds, but I think we're first, and I still feel confident today in standing strong with confidence and yet humility and saying that we are absolutely the best. I wake up every day, thinking about how we are to bring value and create opportunities for our clients.
Yeah, it's amazing. I mean, that's really what the focus is as an entrepreneur. It's a kind of inverted of what kind of we're taught in school, which is that entrepreneurs are just hyper wealthy. All they care about is money and all they care about is profit. And then you realize as an entrepreneur, all you do all day is try to figure out how to satisfy your customers. It's pretty remarkable. It's the opposite of some of that anti-greed quote in parentheses. Just going, before we get into like the details of Collective Genius and some of those takeaways there, transactional funding is something we haven't really talked about on the podcast. Could you just briefly explain how that structurally works in the sense of someone's putting up $400,000? What's the collateral? How does that transaction take place?
Sure. I'll try to, out of respect for time, I'll try to give as much detail in the shortest amount of time so everybody understands. So the first thing you need to do is just listen to the word transactional funding. So the underwriting is based on the transaction. It has little to do whether you graduated from Yale or just got out of jail, right? It doesn't matter. It's the underwriting is done around the transaction. So what that typically means is if you're going to buy a house and resell it in the same day, but you don't have the capital in order to take down look at the transaction from an A to B, B to C. So the A to B is I'm an investor and I'm going to buy a house for $200,000, and the end buyer, let's say, they're going to buy it from you for $250 4 or 5 hours later in the day, right? And so effectively, you got to, even though you got somebody the same day that's going to buy it from you for $50,000 more, you still got to come up with $200,000, right? And so transactional funding, and at its core, there are some deviations of it, but at its core, it's effectively money for a day, right? You borrow money for a day, less typically. At its core, in its infancy, and majority of what transactional funding is that you're going to borrow money and send it back to the lender the same day because you closed your flip side of the transaction in the same day, right? It has been mostly used from a short sale perspective back, years ago. And because a lot of times nowadays, like you say, well, why wouldn't you just assign it, right? Well, it typically involved transactions where on the B2C transaction, if someone was getting financing to buy that property from you, a lender's not going to allow them to purchase an assigned contract, right? So most commonly in its basic form was really, really, really driven around short sales. You're negotiating a short sale. You finally get it at a discount. You need the money to close the deal for a few hours before you resell it. And that's what we did. A lot of people called it dough for a day. We would just wire the money in. And the reason it's called transactional funding is because we didn't pull credit. We didn't check your job history. We didn't check any of that. All that really mattered was that you had a contract that stated it was going to close the same day, that contract had earnest money attached to it. And then we had escrow instructions that we would provide to the title company that basically told them that they could not release or they could not fund the transaction at 10 o'clock in the morning until they had the money in their escrow account for the second transaction.
Okay, that's the really important piece there that I was really looking for. So you use a third party there, and so the risk is really mitigated because you literally say, if this, then that. It's like a binary situation, so you're not caught in the middle.
Correct. Your underwriting, actually, Hunter, your underwriting was more driven around underwriting the title company, their good standing, checking their license, than it was the actual individual investor.
Makes total sense.
Right?
Yep.
Yeah. And now I will tell you this, though, that the industry towards the end got very prone to fraud. And you would actually have, because you used to vet the title companies, you'd be like, okay, they're good, we're good. And then, towards the end, it just got to the point where, you'd have title companies that were actually going in on the shadiness with investors. So it got to, it sounds risk-free, but it wasn't. There were definitely some people that got stung. So as long as you're doing something like that with the person the investor and the title company maybe that you have a relationship with, you're in pretty good shape. But we were doing it across the country and having to vet title companies where we didn't have a relationship or anything like that. So we had to be very careful. We had a very robust business for close to 5 years, but we did take some stings here and there. The last one was for $210,000.
Wow.
But yeah. I mean, we made a ton of money over those 5 years, but we got punched. As I said earlier, we got a punch in the face here and there.
Yeah, if you do volume like that, you're going to experience challenges, especially as the industry is shifting. So, and I appreciate you going to that level of detail there. I think a lot of listeners will find that interesting.
Sure.
So going back to Collective Genius, it's obviously been quite some time since you founded that Mastermind. How has it evolved? You started out kind of getting punched in the face again, seems to be a reoccurring theme, but then of course making adjustments, because I know that wasn't your first and only year. So how did it change from being, 10 people to now what it is today as an industry leader?
Yeah. I mean, I think the biggest way it changed, like I said, we started out with just a bunch of cats in a room having something in common. There wasn't a lot of structure, wasn't a lot of focused outcome. There wasn't a lot going on besides the sharing of information. And so where it evolved is we have gotten hyper focused on creating desired outcome for our customers. I'm sitting here right now at my desk reading, looking at our vision statement, right? It's the Collective Genius is a leading destination for the nation's elite real estate investors looking to experience exponential growth, not only in their business, but as human beings. That very growth will be fostered by maintaining core values that place giving before receiving and family first. We got to the point where, one, we had a vision, mission statement, core values, but wake up every day taking responsibility for that, right? Investors looking to experience exponential growth in their business. And there's a turning point, right, where you begin to take responsibility and you actually get a real company above, just slinging some people in a room. And then you start to find, what does that responsibility entail? And, so we got a lot more structured in how we run the business, how we have our customers interact. we got hyper focused on connections, right? And that's probably the biggest thing that really started to separate the collective genius, because if you look at any social media or whatever, you look at different masterminds, I think it's a little bit humorous, right? Everybody talks about, oh, these are great people and they're smart and they're fun to hang out with. Well, that's fine. You can't put that in the bank.
Yep.
Because, at the end of the day, when you come to the collective genius, you're going to have great people. They're smart. They're fun to hang out with. They're going to share information. But we wake up every single day figuring out how are we going to deliver results for our clients. And that's when CG really turned into more than just a sharing of information. Because the premise of a mastermind is everybody's going to show up and they're going to share something of value, a system, a strategy, a resource. And then they get to talk about their problems. And then somebody else in that room is going to say, Hunter, I've already been through that, brother. I went through that like 2 or 3 years ago. I know the pain you're dealing with. We fixed that, systematized it. I'm going to share that with you. I'll give you our system. You and I can jump on the phone. You can come to my office. I'll help you get through that, right? So there's a camaraderie there, a sharing of information, right? But where CG got real, where it really turned the corner, is CG went from who you might or what you might learn to who you might meet. Because really what separates us from everyone else, I think, in the country is the fact that our level of connection and what those connections are worth is second to none. And probably the best way to clarify that, which is to give you some examples. It's way above and beyond just, again, cool people, smart people hanging out. Really great, right? No, just in the last couple of weeks, for example, we have a gentleman on our group, right? He buys apartment complexes. A gentleman named Tim Bratz. I raised $1 million for him. I put in $250,000. One other member put in $500,000. Another member put in $250,000. We raised $500,000 or $1 million to actually take out some more expensive debt that he had. One of the gals, her name is Connie in our group, who she actually went on that deal with me. She just provided $1.5 million in capital to another one of our members who's a big turnkey provider out of Ohio, right? So there's, and then there's guys who, like a Mike Lockery in Phoenix, who's, seen a big run up in appreciation in his portfolio, but his cap rates are stinking. So he liquidates some of his portfolio and he goes and replaces that portfolio in Phoenix with a portfolio. Since we're maybe heading into a market change, he says, well, I'm going to liquidate. I'm going to buy a bunch of turnkey rentals in Cleveland and Columbus, Ohio, with another CG member. That CG member, a guy named Joe Lieber, has probably sold 120 plus turnkey properties to other CG members, right? Mm-hmm. And that's not something he was doing before CG. And then you think, well, my gosh, if he wasn't doing that, that's all additional volume. Where is he going to get the money to fund those deals? He gets the money from Collective Genius, right? So it's just turned into this expansive network of, I call it a deal flow machine. And that's, to me, the evolution of where it started versus what it's really turned into.
Yeah, it's fascinating. And I think that actually does paint a clear picture, not only of the benefits of the Mastermind group as a whole, but also in terms of market changes. And I really like that strategy in terms of selling out of Phoenix and focusing on, what people would consider more those cash flow markets, those Ohios, those Clevelands, et cetera, where you're not going to see that much volatility in the rental income. When markets change, you may see some vacancy, but you're not going to, you're really kind of protecting to the downside. Yes, you're going to give up appreciation if that continues. But I think in Phoenix in particular, I've heard some stories of businesses, multifamily units in particular, selling for $15 million and then $25 million and then $32 million all within 5 years. So that market's incredibly hot. Now, you've talked a lot about single family and fix and flip, et cetera. Are those the focus of most of the group members, or is there also a lot of syndicators and operators?
Yes. First of all, CG is probably 75% single family focused. And the rest of it is composed of other asset classes, whether it's multifamily, whether it's mobile home park, whether it's self-storage, whether it's land, you name it, right? There are a lot of different asset classes or investors in our group that comprise about 25% of the organization. Now, there are tons of different angles that are taken in the room. And depending on what you mean by operator, I'm not 100% certain, but most of our investors own assets. They're not just flipping houses, right? So most of them have an active income, which is created through the flipping of houses or apartment complexes. And then they take that active income to build their own portfolio. right? So a perfect example might be just everybody that I just ran through in that example a minute ago when I was kind of, Mike Lockery's probably got 70 or 80 units. Joe, who he bought a bunch of those from out of Cleveland, probably has 160. So almost everybody, it's not just people flipping houses. This is typically people that are also building an asset-based portfolio.
Okay. What would you say? Obviously, people are coming there for two reasons. They're coming there to share some of the things that have taken their career to the next level with other people. And then they're coming there because they have some kind of challenge that they haven't been able to overcome, right? Because I know that when you will go to make an investment in a mastermind group, it's because you feel like you're not firing on all cylinders, because it's not inconsequential in terms of that investment. So or at least you're leaving some money on the table, right? It's a good investment of your time. What would you say are the most common reasons that people feel like they really need to take their career to the next level but haven't been able to do that? And what kind of key takeaways can you share with us that you've been like, oh, this is a system that you're not seeing because you haven't taken it to that level? Or what are some of those mechanisms that you see most often facilitate people being able to go to the next level?
Sure. I'm going to take a little twist on answering that question in that it's not necessarily about the quote unquote next level. For most people, it's about how fast you get to the next level. The challenge with being an entrepreneur is that you are blessed with vision, right? You are blessed with vision. Yet at the same time, you have to face the curse of waking up every single solitary day and dealing with reality. And between reality and your vision, right, is a gap. What the right mastermind does is help you close that gap. Does that make sense?
Absolutely.
Yeah. So that's what a mastermind does, right? It's about how fast do you want to get to the next level, right? And I think that's what a mastermind does is it just compresses time and it exposes you to, because you're like, why would someone, if they're firing on all cylinders, want to come to a mastermind? And I'm going to tell you the reason why is because if you think you're firing on all cylinders, it's probably definitely time to go to a mastermind. First of all, you do not know what you do not know.
Totally.
We get people that come into the collective genius sometimes that think they've got it all figured out. And inside of the first half of the day, their jaw's on the floor. Because as an entrepreneur, right, it's one of the and here's another reason why people come, because this is a lonely walk, my friends. I mean, if you're playing a big game, being an entrepreneur, as connected as you may be on a daily basis, can be a very lonely walk. Few people understand you. Few people will ever understand you. And when you show up at a mastermind, you get people that do. And those people are all working together to help you close that gap and accelerate the process to what you just called the next level, right? And sometimes it's about what you don't know. You think you know everything. Trust me, you don't, right? That's one thing. Other things are sometimes you just need to be told, right? A perfect example. Everybody's been spoiled rotten by this market, right? We've had a great market. All your mistakes are being fixed by appreciation. You don't really have to be a solid, savvy business owner right now, but that's all about to change in my humble opinion. But perfect example, right? Like you may be making a ton of money, but where are the holes in your business? We just had a gentleman in our recent group talk about how he audited his funnel, his sales funnel. And he found about 6 different holes where monies were just leaking out. And he's running a highly profitable business right now, right? Why even bother looking at a funnel? And then how did he do it? What were the steps he took to actually audit his sales funnel? Well, it's easy. He gets up in front of the group and shares that with everybody, right? Or, say that you're a Mark De La Tour out of Kansas City. He's in our group, right? He's a turnkey provider. He provides a stabilized single family home that already has a renter in it. It's cash flowing and he sells it and then keeps it under management for you, right? So a guy flips 160 houses a year. He's got probably 600 under management. What's he need to go to a mastermind for? He's probably making $1 million a year, right? Well, things change. Mark was buying everything from the auction. Well, 5 or 6 years ago, that was peachy. That was great, right? But at the end of the day, as the market began to strengthen, margins began to get compressed at the auction. And if you couldn't generate leads direct to seller, you were going to suffocate a slow death. What if you don't know how to do that? Where are you going to go? Who do you want to hang around with? Right? Do you want to sit in your desk and panic? Or do you say, let me go to a mastermind where there are people in there that are sending 150,000 postcards a month that have 3 or 4 people on their sales team that have automated, sequences built into place. So you take somebody who can absolutely be crushing it in one facet But the reality of it is if things change, how are you going to stay sharp? How are you going to stay engaged? Who are you going to, and sometimes you can say, okay, I've been buying everything at auction. I know I need to do direct to seller marketing. Well, that ain't rocket science, but all the steps involved, when you can just pick up the phone and call somebody who's, because think about it. If you're going to do direct to seller marketing, you got to have the right data set. It wants to be driven by predictive analytics. So you really need to know who to mail, right? The 20% of the 20%. What are you going to mail them? What kind of copy? Who's the mail house? What are the costs? What's the frequency? And once you drop 50,000 postcards in one run and you get a 1% response rate with 500 phone calls a month coming into your office that you didn't have before, how are you going to handle those phone calls? How are they going to get sifted, sorted, graded? And once they're sifted, sorted, graded, who are they going to go to? You're running a business. Are you going to be the guy that goes to the kitchen counter every night? No. Right? So you got to hire acquisitions managers. What's their disc profile? What's the best way to, once you bring them on, how do you train them? What type of compensation structure do you put it like? And I'm just giving one example, right?
No, those are hundreds of examples. They're all extremely important. It's most things people have not considered. And, to touch on what you were just saying, there's kind of a balancing act that always goes on with entrepreneurs, which is if you have a system that works, you're like, you know what? Close everything out. Let me just tunnel vision and just focus on getting this to go as fast as possible. And to your point, balancing that with the fact that it could very well be the case that ultra focus, especially in a really favorable market conditions, can lead you to be really exposed if things turn around. For example, if you're not building up your network now, they're not going to be there. Those relationships aren't going to be there, let alone the educational component. The actual network needs to be there for you in order for you to rely on them. So all those systems in place, if you were just focusing on top line, if something changes in your business that makes you have to pivot, then you can be in a really significant problem. So no, I actually appreciate the level of detail because it shows how many moving parts there are.
A good mastermind is like an insurance policy. If you're making a bunch of money, if you're doing well, the money you would invest in a mastermind, whatever mastermind, not necessarily a collective genius, but whatever, right? If you're huge into apartments or office space or whatever, if you're in a mastermind driven around those platforms, it's like an insurance policy that most of the time pays for itself 20 times over or more in many cases. And it just protects you from market changes because, I agree, right? When there's 1,000 foreclosures going through the auction every day, well, you could do that. But if you don't see market, here's the reality of it. We are in a cyclical business. I don't care what asset class you're in. It's real estate. We are in a cyclical business. It's not like funeral homes, right? It's not very cyclical. This is cyclical. The market changes. It ebbs, it flows. When I started the Collective Genius, everybody in that room was a short seller because you had to be. Now I don't have any. And so the reason that I'm banging that drum is because you can get into a spot where you think you got it all figured out and you don't need any help and you can't learn anything. And you don't need any connections because you built this fancy schmancy system that really automates everything. And then you get, as we said earlier, you get punched in the face. That's just part of being an entrepreneur, right? There's no rest for the weary. As soon as you get comfortable, you're going to have to adjust. You're going to have to adapt. And that's what a mastermind allows you to do. It allows you to adjust, adapt, and do it hyper quickly.
I know that you have had a lot of, ultra successful people involved in the community and also sharing their perspectives on not only different strategies, but also in terms of, market cycles. Something is a reoccurring theme in this conversation. What are your thoughts? And I know that real estate is localized, hyper localized in some situations, but what are your thoughts on, the current state of the economy? You mentioned that you think we're due for a correction. How significant do you think that correction will be? Are you seeing opportunities in any particular real estate markets that aren't oversaturated or overinflated? What are your thoughts on that?
Sure. Well, first of all, I've been in real estate for a long time, going on 20 years, but I will start out with saying that this is an opinion. We've all got one and most of them stink. But having done it for a while, and I'm going to largely take this stance from the single family class. I'm very educated in that arena and not so educated on a lot of the other commercial asset classes. So this is going to be geared towards single family, right? And I think that the correction has very subtly already started. In my experience, the heartbeat of the housing market, the single family housing market, the heartbeat is Arizona, more so Phoenix and Southern California. And everything is starting to take longer to sell than normal. The average days on the market is longer. When it takes longer to sell, those rehabbers are going to be more cautious in their buying, which puts pressures on the wholesalers, so it's already started, right? Listing prices are getting reduced more frequently, bigger reductions. So I think it's already started. I don't think it's drastic yet, but I think it's started. And I would say that I am anticipating that it is going to go across because what starts in the West spreads to the East. I think in the major metropolitan areas, this will happen probably within the next 12 to 18 months of continuing. We've experienced a great cycle of appreciation. And I think we're at that tipping point where we're going to start on the depreciation hill or down the other side of that depreciation hill. I don't think it's going to be another 2008, 2009, but I do think that you really need to be. I'll give you an example of our thoughts on this, right? I got a great team that supports me, and we just did planning for our annual meeting in December. And our theme for that event is scale to get better versus scale to get bigger. And a lot of people, and I would suppose a lot of people on this call were victims of the 2008, 2009 crash. And when the next time it happens, or the next time that level of opportunity comes around, you don't want to be a victim. You want to be a participant, right, in the fun. And so the only time you can ever predict a market cycle is when it's in the rearview mirror, right? In other words, you can't. We think that it is changing right now, and we are going to be encouraging our members to tighten up operationally. So with you, the way that you raise money, Hunter, obviously you're going to want to work with when you deploy capital, you are going to work with those who are the best operators in the business. Because when you can be sloppy from an operational standpoint, when everything's appreciating, sometimes it's good to be sloppy when things are appreciating, because if you underbid a project and, oh gosh, we underbid that project by X amount of dollars and it's going to cost more, and then it takes you 6 months longer to complete your project, which normally is a mistake, it can actually serve you because the market's appreciating the whole time. And when you sell it 6 months later, you actually make more money because you made mistakes. Is that making sense so far, Hunter?
Oh, yeah, absolutely. I really go ahead. I don't want to stop your flow.
Sure. So my point there is that now is the time to get hyper operationally sound. Whether you are syndicating, you want to make sure that you work with the absolute best operators in the business. We are encouraging our members, hey, instead of continuing to try to get bigger and bigger, tighten up. You're an IndyCar, right? You're trying to go around the fastest track as humanly possible, ... without crashing. How do you prevent crashing? 9 times out of 10, you keep operationally sound. How do you do that? You take a pit stop. You pull over, you change the oil, you tighten, you switch the tires, you tighten up everything, you make sure your driver's hydrated. And so we're telling everybody it's not from a negative place of, oh gosh, the market's crashing, don't buy houses. But more so, how do you put yourself in a position where you can prepare, position, and prosper? And our thoughts are, as an organization, how do you prepare? What are the things that you need to do, right? Start looking at your portfolio. Get rid of the bottom 20%, right? If you have assets in your portfolio that are, you know what, I bought this right, but it's just a pain in the butt because it's old and it always needs repairs or whatever. Let me go ahead and let me get out of this thing so I can, first of all, I've had it for a while. I'm only going to pay cap gains on it. Let me get out of this thing while I can suck up some of this appreciation, build up some cash, right? That way I know I can take care of my family. I'm anal retentive on that. I mean, I have a 4.5-year-old little girl. I'm 47 years old. The last thing I would ever want to do is start over. And so to minimize my risk I like to have a cash position. And so when you're running hard in this recent market we've had, you're all in. Well, now, okay, look at your portfolio. Get rid of some of that lower level stuff. Take some of the appreciation you've gotten off of it. Get some cash in hand. Number one, that protects your family. Number two, it positions you for when the market does turn and things go back on sale, because not a whole lot on sale right now, unless you can really, really, are talented at finding a good deal. Now you're positioned financially from a bankability perspective because, one, you have some cash. And number two, you have the ability to make it through the storm. And number three, you have the ability to have cash to actually play and be a participant, right? So I think it's happening. I don't think it's a red alarm, but I can tell you that only time you can really know when a cycle happens is when it's in the rearview mirror. And so do you want to wait till it's in the rearview mirror? Or do you want to start positioning and making sound decisions now so you can prepare for it. And more importantly, be able to take advantage of it and prosper during the next downturn.
Agreed. And I think there's definitely a time in which I was going to networking events where the market sentiment and a lot of people that I saw as being very successful and were very successful were basically saying, what you need to do right now is get the biggest bucket you can and try to catch all these raindrops, because it was just falling in a good way, right? It was 2010 and it was happening. And it's something I took seriously but didn't act on. I started very slowly and was very risk averse and continued to be to this day, and I'm happy that I made those decisions. But now that I understand the real estate game and now that I have the network that I have, a 20% reduction in price, for example, would be an overwhelming benefit to my business. And I'm sure that you and a lot of the people that you're associated with can agree with that. That would be, I don't know that we're going to see something like that, but if that does happen, it will present a tremendous, tremendous opportunity. We have appropriate financing in place to weather that storm. The key then would just be a great basis. And actually, that brings me to a good point. You mentioned a lot about hard money loans. And I think that Bruce Norris is one of the people that said, the cycle's over when the bank says no. Right? They're the ones driving the whole ship. You have a good idea of what the private money, hard money loan industry looks like right now. What do those typical terms look like? What does the typical loan to value look like, or the loan to purchase price? And what does those interest rates look like? Just to give us an idea of where we are in the cycle.
I think hard money is going to come back to life. It's really been suppressed from the perspective that, you've got different levels of financing structure, right? You've got your community banks, or your cheapest capital that an investor can usually get. Then you used to have like hard money, right? Well, now you've got Wall Street firms that have kind of gone in between those. They're not hard money. They're not as cheap as lending as community banks, but they're kind of filling that gap in between. And because they're doing it, and because there's so much money in the marketplace, they've really compressed the margins for hard money lenders, right? But I do think that when the market turns, it's a double-edged sword, Hunter. I think when the market turns, hard money, there will be another huge opportunity there, but you have to really, really be super cautious in. Here's the thing you got to be careful of. Just as I said earlier, that if you bought a house and you made a bunch of mistakes, it could actually serve you well because it took you 6 months longer to flip the house and a house appreciated. Well, if we move into a depreciating cycle and you're evaluating an asset on whether or not you should lend hard money on it, do you evaluate it based upon what it's worth today? Or if the market is potentially in depreciation mode, do you evaluate it on what you think it's going to be worth in 6 months? Does that make sense what I'm trying to explain? I'm not sure if I'm articulating it very well.
Yeah, you're underwriting it to be conservative, basically, to anticipate that correction. And does the underwriting still make sense?
Perfect. Yeah, you made it much more simpler than I was. So your underwriting during a down cycle is going to have to be way more conservative in that, when the market's going up, you don't have to be conservative. You're like, hey, if it takes longer, I'll get extension fees and my investment's more secure because my overall LTV is actually going to reduce in the process.
Mm-hmm.
Well, that coin kind of flips because sometimes in a market that's depreciating, you don't necessarily know. You don't know if you're catching a falling knife or not, right? And so I think there will be big opportunity, but I do think that you're just going to have to be extremely cautious from an underwriting perspective when you're evaluating deals until the market kind of settles into okay, we're evened out and we're on the way back up.
Would you be creating seconds on flips right now? Let's say there was a property that was $100,000 in a market like Memphis, Tennessee, for example, and there's a first on it that's $80,000 of purchase price, and you have the opportunity to put that additional $20,000 in as the second, so that the property would be basically 100% financed for the purchase, and then the seller or the buyer, let's say, is going to put up the money for the rehab. Would that be a type of structure that you'd be considering right now in a market like Memphis, or is that be too high on the risk scale, all things being equal, considering the background of the flipper, et cetera?
Sure. I used to do a lot of seconds when we were in this last upcycle. I would not personally be, and again, every deal is a case-by-case basis. I want to preface it by saying that, in the scenario that you just gave me, I'm going to say no, just because of the cumulative loan to value. But, if somebody says, hey, I bought a house that's worth 80 before it's fixed up and I paid 10 grand for it and I need a second for 30. So you're 40 in on an $80,000 asset. Would I take a second? Yeah, probably, because the overall cumulative LTV is still low. If something goes wrong, I can buy out the first because, I've got the money to buy out the first. So I'm in a safe position. But when you're in a position where you're taking a second lien in a market that I feel, at least in the single family asset class, is up near the top, I personally would not be doing seconds in with that risk profile that you just gave.
Okay.
That's just my personal, and again, it is deal by deal basis. In the examples that you just gave me, the answer would probably be no. Or I would have want it cross collateralized. That might be another way to look at that. For example, Hey, I'm going to give you a second, but I want to cross collateralize it. Okay, wait, you got 80 units in a portfolio and you own 7 of those units free and clear. Then I'm going to give you the money, but I want cross collateralized against one of the units that's free and clear, right? So, if I could reduce my risk, and I do that a lot actually, cross collateralization, or someone will come to me for a deal and I'll say, no, I won't do that deal, but I'll lend you the money on one of your free and clear properties in first position, right? So I think now you just have to really be looking at all your options but seconds to me right now are just it's just not a position that I would want to take. I think there's too many other opportunities out there. It's easy because everybody wants it, right? Every investor right now thinks that they shouldn't have to bring any money to the equation. Everybody should give them 100% financing and, because they've gotten spoiled. But for that very reason is what makes me cautious.
Totally. And I actually just want to clarify because sometimes people use different terminology to describe different things. And I try to look at things. Loan to value typically refers to the after repaired value. Loan to purchase price can be very different. So in the example that you gave where you're buying a property for $10,000 that's likely worth $80,000 once it's repaired, the difference between loan to purchase price and loan to value can be really significant. So for the investors that are listening at home, if you see a deal, let's say it's for a hard money fund, and it's talking about, maximum of 70% loan to value. When I'm talking about the worst case scenario, if I'm trying to analyze that, I want to see what the purchase price is, the as is purchase price. Because if the borrower buys the property and then just simply checks out and decides to go to the Caymans, you're going to be stuck with that property in its current state before they flipped it up. So just wanted to clarify that because it makes a big difference.
Well, not only do you have to go through foreclosure at that point, then you got to fix the property.
Yeah, totally. And you may not have the network to do that.
And that property is going to sit there while you're going through the foreclosure process. And so that's very sound advice. Don't always look at that you're lending on, after repaired value. Look at on the existing asset value. Because like you said, if the market gets dicey or somebody runs into problems and they bail out on that project, you have got your hands full.
I'd like to ask a question about some of the technological solutions that you may have seen make a big impact on people's lives through the mentorship or mastermind group. Is there anything that comes to mind in terms of the way people have been able to leverage technology to systematize or automate their businesses that you've seen really help people out?
There's some good CRM platforms in the marketplace today, but I think that's what most people are. I can't really think of any particular piece of software that is just, revolutionized the game, if you will. I think in a lot of cases you're forced with, most people don't even use their CRMs the way they should. Heck, I'm probably guilty of that, right? We use Infusionsoft, and sometimes I'm like, oh my gosh, I wish I could change, but the pain of changing is more than I could bear. And so I really don't think, I think the biggest, most important thing is really construction processes and lead management. Mm-hmm. From a lead management perspective, I think it's critical that you're using technology to follow up with your leads in an automated fashion. The reality of it is, if you get 100 leads and you close 2 of them, there's 8 more in that stack that are going to close, but they're going to close in the next 6 to 12 months when time and circumstance change. It's very difficult as a human being to stay in touch with all of those leads. And so you've got to have a platform that does it, that, has automated systematic follow-up. So I don't know if I would necessarily focus so much on a particular system, but more so what are the avenues that are so vital in a particular system. And I think, automated follow-up is critical. And then I think, if you're in a business where it involves construction management, I think the construction management component of a platform is critical.
Yeah, there's so many moving parts. You really need help. Just for the listeners, if you're interested, I use Pipedrive as a CRM. There's an app that I haven't really talked about much, but I'm a huge proponent of it, which is Mixmax, which allows you to templatize your email responses, and you can also set autoresponders as well. And that alone probably saves me 15 minutes a day. And 15 minutes a day is really hard to come by when you're trying to maximize everything. So those are a couple there. And with the same thing in thought, which is that it's not really the technology, it's really how you use it. And if you're thinking about things in a systematized fashion, you're going to help yourself a lot. Now, this is something I absolutely have to ask because I just don't know many people that have done so much in-person networking, built a business around it. But I'll put it this way. In LA in particular, it's hard to go to a bunch of networking events. It's something that I don't do too much anymore because I focus more on the online component. But I do notice that in-person networking is it's a skill that you have to achieve for most people. Do you have anything that you could suggest if people are just getting started, they're just going to their first couple networking events, tips for them to really build some meaningful relationships that'll get them the results that they end up wanting for their career?
I think I'll add some color to this, but I think the single biggest thing is you have to go with a plan. Right? Like if you just show up to an event and you're just like, hey, I'm going to show up and eat the donuts and go home, that's probably what's going to happen. You're going to eat donuts and go home and not going to get a lot out of it. My thoughts are, be intentional. That's probably the biggest thing that I could say from a networking perspective is be intentional. If you walk into a room with 100 people, there's maybe 10% of that room that, where there are synergistic relationships. And so when you go into any type of networking platform, how can you be intentional about it, right? And once you go to the first time and you get the lay of the land, did you kind of identify, okay, the next time I go, I need to intentionally connect with these 4 people? Or does this membership organization have a roster or a list of profiles of who's involved? And can I look at those and figure out who I should intentionally be meeting with when I show up? So the biggest thing is intentionality. The second thing I would tell you is that a good organization, a solid organization, will meet you halfway with that intentionality. And what I mean by that is, for example, in our organization, Collective Genius, everybody gets up and says, I need help with X, Y, and Z. Well, we have a leadership team that is guiding those conversations, and they say, Hunter, you need help with X, Y, and Z? Well, I'm going to introduce you to Tom because he's a master at X. And then I'm going to introduce you to Sharon, who can help you with Y. And then we've actually also got Kevin over here, who's just crushed Z in the last 6 months. And so instead of just saying like, hey, make sure you talk to those people, we actually physically record and write down the connections that we say we're going to make for you. And then we manifest them after everyone goes home, right? We put you together a text message or an email saying, hey, Hunter, I want you to meet Tom. He said he could help you with X. And then in the email, we say, hey, Hunter, at our last mastermind, you were saying that you were struggling with X, and Tom's actually a master at X, and he said that he would be glad to help you. I've copied him on this email. You guys take it from here, set up time to chat, have some fun, make some money. And so I think when you combine your personal intentionality with an organization that is intentional about creating connections for you as well, you got an opportunity for a home run.
Yeah, I couldn't agree more. And I actually like some of those suggestions there by really facilitating the original conversation, because sometimes that can be the missing piece that makes it all the time that you spend at the networking event completely invalid. If you don't actually send those follow-up emails, you're not going to get a huge bang for your buck.
No, because you're going to get back home, you're going to get in your business, you're going to fall victim to the whirlwind, and you're not going to actually implement anything that you wanted to get help on. Right?
Exactly.
That's what's going to happen, because you're going to go home and you're going to be like, oh, that guy said he would help me, but I didn't get to really meet him, and I'm not comfortable calling him. So I'm just a little bit, we just remove that from the equation, and we create the connection, make it manifest it for you.
So, the first part that you said once I introduced you was pretty interesting. And I think it actually speaks to the brand and the Mastermind group as a whole. You have had the opportunity to talk with, network with, learn from a lot of really people that are successful financially, but sometimes that financial success doesn't really come along with the well-being that most people assume it does, particularly with things like relationships with families or romantic relationships, et cetera. And I know that's a really big focus of your group. I was wondering if you could share any stories, and of course you can keep it anonymous, about entrepreneurs that are kind of living in entrepreneur poverty, right? Where they may have money, but everything else may be a little bit more challenging. Do you have any stories like that you may be interested to share, given how you're positioned in the business and how you, particularly as you mentioned that first and foremost that you're a father, especially?
Yeah, I mean, I don't know if you heard me earlier when I was just sharing our vision with you, right? The last few words were that our growth will be fostered by maintaining our core values that place giving before receiving and family first. And
Exactly.
anybody that's building a business, I mean, if you can figure out how to skip the grind, I'm all ears. Maybe yeah, it takes hard work. I don't know any other way around it. Anybody that tells me they got a 4-hour work week, or they're living the dream, I'm always suspect of that. But my point is that you're always trying to find a balance, and I think that you've got to. Being successful is equally as difficult as failing. I'm going to say that again. Being successful is equally as difficult as failing, because I'm a very, very blessed and fortunate human being. I've certainly worked my tail off, but I've got a wonderful business. I get to make a lot of impact. I've got a wonderful wife, totally amazing 4.5-year-old, beautiful home, yada, yada, yada. All those boxes are checked, right? And super grateful for all of it. But I can tell you, it's hard every day to wake up and try to be everything to everybody. I got to be a good business. I got to be a good leader in my business. I got to be a good husband. I got to be a good dad. I got to da, 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 da. And there's a lot of pressure. Even when everything is going good, there's just a lot of pressure. So the first thing that I want to just share before we delve into this is that if you think that if you're going to really be successful in all facets of your life, that it's just going to be easy and there's no pressure, I don't know that that's real, right? Pressure is sometimes what keeps you. You'll definitely have areas of flow, but pressure is sometimes what keeps you. It's what makes you good at everything, is because you're accepting of that pressure. But bottom line is, yes, Hunter, I can share with you examples. And I think at different phases of an entrepreneur's life, I've been that person, you've been that person, and probably a lot of people listening have been this person. But we always tell people when they come into our organization that growth is not always about bigger numbers. Sometimes it's about smaller numbers. So, we've had gentlemen come into our group. He's out of Texas, and, he comes in and we give people permission to be honest, like check your ego at the door. And he says, I'm making $1.7 million a year, but I'm working 80 hours a week and I live on an airplane and I don't ever get to see any of my kids' games. Growth for me, I don't need to grow my income. I'm good with $1.7 million. I'd like to get it done in 35 or 40 hours a week and actually get to hang out with my family. And so what happens is when you're in a good organization, those people become your friends, because when you're vulnerable with each other and you drop the ego and you get to go into a group of people and say, okay, I can be real here. I don't have to be the guy that takes over the world all the time. I can come in here and be real. Then you develop relationships at a deeper level outside of how many deals do you do? How much money do you make? Right? So when you have that deeper relationship, then you become accountable to each other. Hey, brother, let's touch base, right? I'm fortunate to be in a space in my life where, I've got a great balance. A couple years ago, I was in the same spot. I was grinding, making a ton of money, but perfectly miserable. Why don't you and I just huddle up once a week, and I'll kind of, we'll talk and I'll kind of help you, continue to make the right steps to, hey, not necessarily sacrifice your income, your business, but get to where you're putting your family as a priority. And once we put them as a priority, what are the steps you need to take in your business in order to allow you to do that? And so, any good organization is going to allow its members to be real and to be candid and to tell the damn truth is the reality of it. Because when you're an entrepreneur, you don't have it figured all out. A lot of people can think that on the outside looking in, oh, you make this, or oh, you have that, or da 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 da. And there's a lot of it can be a very challenging place to try and do it all and do it all well. And sometimes we don't get it right. And it is very often that our members will come in and share with each other, where they might be struggling personally. And that in reality is what makes any good organization a good organization. Is let's stop pounding our chest and how do we figure out how to walk out of here as better human beings, not just doing more deals, if that makes sense.
Absolutely. I actually agree with that. And I think that, to your point, there's a lot of authors out there that are really promoting the hustle, get out there and multiply your time that you're working and your efforts, and you're going to be able to succeed. I think that's actually really good for people that are getting started. But as soon as you start to see success, you start to realize that the reason that there are people that are much more successful than you isn't that they worked 4 more hours a day than you. It's that they were able to put in place systems that allowed them to scale effectively without incurring that type of admin.
Yeah.
And you have to be able to leverage other people's experience in order to see those systems. Because if not, I mean, I have done 16-hour days, many, many days in a row. But then you realize, wait, like if I am clearly not using my time, because the difference between me and Warren Buffett is not that he was able to work more than 16 hours a week. It's the opposite of that, quite literally.
Exactly.
Awesome.
I think you just get to a place, everything has its place. And when you're first starting a business, that is most of the time, that's what it takes is 14, 16-hour days. You're breathing life into something. But the reality of it is as you experience success, you get a little older, a little more mature, especially you have kids, your priorities, what becomes important changes. And I'm 47, I have a 4.5-year-old. If somebody said to me, hey, Jason, next year you can make another $1 million, but it does means you're not going to be able to take Ava to school. You're not going to be able to read books to her before she goes to bed, and you're going to miss her dance recitals. But you can make an extra $1 million net. I would have to pass I wouldn't even have to think about it.
Yeah.
I wouldn't even have to think about it. And it's just because at this point in my life, once your needs are met many times over, the additional amounts of money just loses the draw. It loses that adrenaline rush that it once gave you, because you realize you're set.
It's just numbers. Just numbers in the bank account. You add a zero, take away zero, add a zero. It's inconsequential at a certain point.
Yeah.
That's really, really valid. And I actually think that's a really great note to end it on, because I think it covers a ton of ground. And again, I really appreciate this conversation. Before we go, I want to give you the opportunity to tell listeners how they can learn more about Collective Genius and learn more about your firm.
Sure. If you'd like to learn about the Collective Genius, you can go to thecollectivegenius.com. That's www.thecollectivegenius.com. And we're an application invitation only type of platform. Typically what happens when you go there is you can check it out. And if it's something that you feel is interesting to you, you can fill out an application, and then we kind of put that through a grading process and figure out if on the surface of that application it seems like there might be a fit. If not, we will be first to tell you, you will not be sold in our organization. We are more driven around finding the right fit. And if we're not, we will absolutely tell you. It's more of a screening process than it is really a sales process, because even if we get past the point of screening to think that, hey, we're a potential fit, we just get on the phone, we have a conversation, and we identify some synergies. And if they're there, you come to the Collective Genius and we check each other out. We don't say, okay, you're a good fit. Now give us a bunch of money and hopefully you'll like it when you come. We check each other out, find synergy, and then you come to check a meeting out. And then only once you're at the mastermind, if there is a potential fit and we both feel the same way, that and only at that point do we look at and discuss membership. So it's super easy, laid back process. There's no pressure. We just don't believe in that. I think it's one of the big reasons we have an awesome organization as well. So Hunter, thank you, brother, for giving me the opportunity. Hopefully we shared some value today. Hopefully we dropped some knowledge. I have enjoyed my time with you, my friend, and hopefully you'll continue to share these awesome podcasts with your listeners and keep helping people have some fun and make some money.
Definitely enjoyed the conversation, and thanks again for coming on.
Absolutely.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC, because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.